Hello everyone, I'm Ed Sarkeesian, COO of Yankee Capital Partners. Today we will go through the construction and multifamily module. We will review our construction management strategy for value-add acquisitions, including our process in determining what capital expenditures are most beneficial to profitability. A key component to understanding how we invest is understanding what a value-add strategy entails. We find that the sweet spot in multifamily real estate investing is buying properties in the growing markets where we can select property improvements in order to increase the value of the property. The execution of this plan is twofold. First, we implement the capital expenditures plan, and second, we also improve on operational efficiencies. In the end, we will have increased the income, lower costs, and improve the property, thus increasing returns for our investors. Construction is one of the key ways we raise value of the property. This is one of the most important aspects in the strategy, and we find that having an in-house construction team provides us with competitive advantage. It helps us lower expenses on projects and respond faster to potential acquisitions. We have established relationships with many subcontractors who are able to provide us with below market pricing due to the volume work we provide. For some projects, we have larger contractors in order to complete them with speed and minimize the impact to the residents. In other instances, such as unit turnover work, we have smaller companies, thus striving a balance between speed and cost. There are many steps that we take to have a full understanding of all costs associated with our future capital program in any potential investment. In the pre-acquisition phase, we walk the site with local vendors from many of the trade groups and our property management company. We receive estimates which in turn we use to feed our financial model. After we acquire the property, we typically don't do any work for the first 6 months in order to stabilize the property and get to know the residents. While that happens, we finalize our scope of works, our bidding, and plan out our test units. We also visit a competitor properties and figure out what their offering is and how our property is going to compete with them in the long term. Part of the construction entails requirements necessary to complete requested by the lender. Improvements such as pavement repairs, leaking gutters, and walkway repairs, and there are also green or environmental projects requested by them. The lender allows you to decrease your interest rate on the property by making necessary environmental repairs and investments. For example, with our recent acquisition, we had a green loan program and installed water-efficient toilets to decrease wastewater, as well as repaired and replaced kitchen faucets and shower heads. This is not only a corporate responsibility for the environment, but also makes the property be more efficient. These projects amounted to a $90,000 upfront investment, but lowered our interest rate by 1/3% in addition to usage savings for us and our residents. The interest rate deduction is a material difference on our financial model, given this was a $12 million loan. For exterior upgrades, we typically look at painting, siding, walkways, as well as roofs and windows and doors. Some of the items don't directly impact the revenue, but used in the overall offering to help drive the property value. We also look at additional revenue sources, such as installing carports, adding reserved parking spots, as well as package lockers and other add-ons. These can help contribute to the revenue through fees associated with these additional amenities. In some situations, we'll look at adding backyards and upgrading the balconies if the property is dated. Backyards at the property create value since there will be a $75 premium to the tenants. As you can see in the bottom pictures, we have added backyards in the courtyard of the property highlighted with red circles. This additional increase will drive to our bottom line. In addition to the backyards, we've also decided to update the balconies, not only to make them safer as the old balconies were rotting, but also change the look of the property. See before and after in the top left and right of the slide. Interior upgrades can be done in-unit and on the property amenities. Current amenities can be upgraded and reconfigured to address resident wants and needs. The leasing office in the main building is critical in making good first impression with prospective residents. Beyond seeing the exterior, this is where the applicant will first experience the indoor space of the property. It is important that the space is up to date and modernized so that the resident can appreciate the value they're getting with their rent and show them how attractive the community is. A unit upgrade program is set up based on the current market conditions and in some cases the unit condition. Property assesses each unit prior to the tenant move out, and a decision is made to rent it as existing or perform an upgrade if the market can bear the increase in rent. These decisions are typically made 30 to 60 days in advance so that contractors can be notified and the materials can be ordered. As you can see in the picture here, this particular unit is dated, the appliances are older, as well as the carpet at the end of its life. The kitchen is partially closed off from the living space and is typical of a 1980 construction. The goal for each renovation is to make sure that the capital invested will get you the highest rent increase. We have created a standard unit upgrade package with all materials picked out. This particular unit, we actually have decided to renovate the kitchen, install LVT planks, as well as upgrade the countertops to quartz and create the open concept kitchen. Investing in higher quality materials provides not only a better look, but less maintenance in the future. When we consider any unit renovation, that is our thought process. Planks, for example, can be more expensive than simply replacing the carpet, but they last longer and are also aesthetically pleasing and much easier to repair and maintain. This is an element where you're not just thinking about the next tenant, but on the long-term scale, how you're maximizing the value of what you invest into upgrading each unit. This one has also been modernized with new appliances, a nice tile backsplash, and a more open concepts with the kitchen being opened up in the living space. The countertop in this unit ended up actually being 30% less due to our strong relationship with subcontractors in the area who were able to provide us a steep discount to other contractors due to our relationship and the amount of work we provide. As I mentioned before, nurturing these relationships is really a long-term goal and pays back tenfold in the future. Let's briefly go over why we make these investments into the unit upgrades. A typical unit upgrade costs approximately $8,000 and achieves roughly an increase of between $150 to $200 from the current price levels. While some units that are slightly upgraded by the previous owner might cost $4,500 to upgrade and will have a premium of a little bit less, between $75 to $100 increase. The cost benefit of this actually spreads out over 4 to 5 years as you get the money return that you invest into the units over that period of time due to the increase. Our investors are able to benefit twofold. One is from the increased cash flow on a yearly basis, but also with the increase of the property value, which is also called forced appreciation. A further example of how you can increase value through efficient construction management is reflected in the impact of the net operating income shown in the slide. With changes to the net operating income of the property, as you could see in year 5 to year 10, increasing from 1.4 million to 1.8 million due to the upgrades that were being done as well as the rental increases, the property value actually goes up from 28 million to 36 million as shown in the slide. As you can see, for a value add strategy, construction plays a critical role in generating additional cash flow and ultimately increasing the value of the property and providing our investors with higher returns. Thank you for watching this module. We hope you found this video helpful. Please feel free to reach out to us if you have any questions or want to discuss this topic further. Don't forget to come and find us on our social media pages for more updates or browse our other video modules.